The year 2025 began with a familiar chill for Canadian businesses, and it wasn't just the winter air. The United States, under the returning leadership of Donald Trump, unleashed a new wave of economic hostility. A staggering 25% tariff was suddenly imposed on most Canadian imports, with a further 10% slapped on vital energy products. This move sent shockwaves through industries that had long depended on stable trade across the world's longest undefended border. The tension was immediate and palpable. Decades of carefully constructed trade relationships seemed to crumble overnight, replaced by uncertainty and economic anxiety that gripped the nation from coast to coast. The justification for these punitive measures was built on dramatic and wildly exaggerated claims. President Trump declared the U.S. was suffering from a colossal $200 billion trade deficit with its northern neighbor. However, the facts told a very different story. Official statistics from the U.S. Department of Commerce showed the actual trade deficit was a mere $35.7 billion. This massive discrepancy between rhetoric and reality highlighted the political nature of the tariffs. For Canada, this was a moment of reckoning. The reliance on a single dominant trading partner had suddenly become a critical vulnerability. Canadian leaders understood that merely reacting was a losing game. A fundamental shift in strategy was required. The country needed to forge new pathways to prosperity. This realization sparked a bold pivot in Canadian trade policy. The decision was made to turn eastward across the Atlantic Ocean. Instead of escalating trade war with the United States, Canada chose to strengthen ties with the European Union. This was a proactive and forward-thinking strategy aimed at diversifying Canada's economic future. It was a declaration that Canada would chart its own course on the global stage. The key to Canada's ambitious pivot was an agreement that had been years in the making, the Canada-EU Comprehensive Economic and Trade Agreement, or CETA. Provisionally in effect since 2017, CETA was suddenly more important than ever. It was the perfect tool for a country seeking new friends. The agreement was designed to tear down economic walls, eliminating tariffs on an incredible 98% of all goods traded between Canada and the massive EU market. This wasn't a minor adjustment. It was a sweeping overhaul of the trade landscape, offering Canadian companies unprecedented access to over 500 million affluent consumers. It was a ready-made alternative to the closing doors in the United States. Canadian leaders and diplomats moved swiftly to promote CETA as the cornerstone of this new economic direction. They championed the agreement as a symbol of a shared commitment to open, rules-based international trade, a stark contrast to the protectionist wave rising in America. The message was clear. While one powerful nation was building walls, Canada and the EU were building bridges. This diplomatic push was essential for reassuring Canadian businesses that there were stable, profitable markets available beyond North America. The government encouraged exporters to explore the vast opportunities that CETA had unlocked, from the vineyards of France to the factories of Germany. The benefits for Canadian exporters were tangible and immediate. For small and large businesses alike, CETA simplified the process of selling goods to Europe. The elimination of tariffs meant that Canadian products could be priced more competitively, making them more attractive to European buyers. Imagine a small maple syrup producer from Quebec or a tech startup from Waterloo suddenly finding it as easy to sell to Berlin as to Boston. The agreement cut through red tape, harmonized regulations in certain sectors, and created a more predictable legal framework for investment, giving Canadian entrepreneurs the confidence to venture into new and unfamiliar markets across the Atlantic. This strategic shift was more than just an economic calculation. It was a profound statement of Canadian values. By embracing CETA and turning towards Europe, Canada was signaling its unwavering belief in international cooperation and free trade at a time when those principles were under attack. It was a courageous choice to look past the immediate storm and invest in long-term relationships built on mutual respect and shared interests. The pivot demonstrated that Canada was not a passive player on the world stage, but an active architect of its own destiny, determined to build a prosperous and secure future for its citizens through global engagement. The results of Canada's focus on Europe began to show quickly, validating the strategic pivot away from over-reliance on the American market. Canadian exports to the European Union saw significant and encouraging growth. This wasn't just a minor uptick, It was a substantial increase across several key sectors of the Canadian economy. The numbers told a compelling story of successful diversification. Companies that had once focused almost exclusively on shipping their products south of the border were now finding eager customers across the ocean. This burgeoning trade relationship provided a much-needed buffer, helping to soften the economic blow delivered by the harsh U.S. tariffs. The impact was particularly strong in industries that had been directly targeted by American protectionism, such as metals. Canadian aluminum and steel, facing steep levies in the US, found new homes in European supply chains. This shift was critical for protecting jobs and maintaining production in a vital part of Canada's industrial base. Similarly, the agriculture sector reaped enormous benefits. From grains and oilseeds to high-quality meats and seafood, Canadian farmers and producers discovered a vast and welcoming market for their goods. The growth in these areas proved that Canada's high-quality products could compete and win on the global stage when given a fair chance. This diversification was important for more than just its immediate economic benefits. It fostered a new sense of resilience within the Canadian business community. For decades, the default plan had been to succeed in the United States. Now, companies were forced to think globally, to innovate and to adapt to different market demands. This process made them stronger, more agile, and less vulnerable to the political whims of a single trading partner. The shift to the EU was not just about finding a substitute for the US market. It was about building a more robust and dynamic economic foundation for the entire country for generations to come. The success of the EU pivot served as a powerful example of Canada's ability to navigate a complex and changing world. It showed that the country could forge its own path and build prosperous partnerships based on shared values of openness and cooperation. While the United States remained an essential trading partner, the growing relationship with the European Union provided a crucial element of balance. This newfound equilibrium gave Canada greater economic stability and enhanced its standing as a reliable and forward-thinking nation committed to the principles of fair and open international trade, proving it could thrive even amidst global uncertainty. Just as Canada began to feel secure in its new European partnership, the landscape started to change once again. The European Union, facing its own set of global pressures like the COVID-19 pandemic, geopolitical tensions with Russia and China, and internal political shifts, began to turn inward. The EU started pursuing a policy it called open strategic autonomy, a complex balancing act between maintaining open trade and protecting its own security, environmental, and social priorities. For Canada, this meant that the once wide-open door to Europe was now guarded by a growing number of complex rules and new expectations, creating a fresh set of challenges for Canadian exporters to overcome. These new hurdles came in the form of sophisticated regulations that acted as non-tariff barriers to trade. Canada now has to contend with measures like the Carbon Border Adjustment Mechanism, which essentially puts a price on the carbon emissions embedded in imported goods. Other new EU rules concerning deforestation, foreign subsidies, and anti-coercion instruments have added layers of complexity and cost for Canadian businesses. Complying with this intricate web of regulations requires significant investment in new processes and detailed reporting, making it harder for some Canadian companies to compete in the very market they had pivoted towards for relief. Furthermore, the long-term stability of the CETA agreement itself is not fully guaranteed. While it has been provisionally applied for years, the deal still requires official ratification from every single EU member state to become permanent. This process has become entangled in the messy world of domestic European politics. The rise of far-right parties with protectionist leanings, combined with widespread protests from farmers who feel threatened by foreign competition, has created significant opposition. Countries like France have shown reluctance, putting the future of the entire agreement at risk and creating a cloud of uncertainty over this vital Canada-EU relationship. In conclusion, Canada's bold pivot to Europe was both a strategically brilliant response to American protectionism and a powerful statement in support of global trade. The initial success was undeniable, providing a critical economic lifeline and fostering national resilience. However, this new friendship is not one that can be taken for granted. To keep the partnership strong, Canada must remain active and creative. It must proactively work with the EU to navigate the new regulatory challenges, continue to highlight the clear benefits of CETA for both sides and deliver on its promises. Canada has shown the world its commitment to fair trade, but it must now demonstrate the agility and dedication needed to sustain it.